Welcome to episode 1 of the Lost Lessons of Money series, where we cover the topic of the forgotten crash of 1873. It began in silence. No headlines, no crowds in the streets. Only a subtle fracture in the machinery of global finance. Then, the descent. Banks disappeared, empires faltered, and fortunes dissolved in a single night. The year was 1873. Its reverberations still shape our world. So dismal was the situation at the time of the crash that many bankers were stuck with fear. Wall Street froze. Many people were down and out during that time. The world of 1873 was drunk on progress. Railways spanned continents. Telegraphs connected hemispheres. Money flowed freely under the gold standard, a promise backed by metal and faith. In Vienna, Berlin, London and New York, investors believed a new era of limitless growth had begun. But beneath the glitter, a trap was set. Credit built on speculation, not production. Sound familiar? It started in Vienna. The city was in the throes of the Gründerzeit, a feverish era of industrial expansion. Fortunes were built on speculation, and an air of boundless optimism masked a deeply unstable foundation that was about to shatter. On May 9, 1873, it did. On the floor of the Vienna Stock Exchange, years of speculative railway mania came to a screeching halt. The bubble, inflated by risky investments in unprofitable railroads, had burst. Panic erupted as the market completely collapsed. In an increasingly interconnected world, the contagion couldn't be contained. The financial ties that bound Europe and America now became a conduit for crisis. As European banks scrambled for cash, they began calling in their American loans, tightening the screws on a US economy already over-leveraged in its own railroad boom. Within weeks, panic crossed the Atlantic. The tipping point in America arrived on September 18th. The firm of J. Cook & Company, a financial titan that helped fund the Union's Civil War victory, suddenly declared bankruptcy. Cook had overextended his firm financing the ambitious Northern Pacific Railroad. When he couldn't sell the bonds, the nation's most trusted bank failed. The news of Cook's collapse hit Wall Street like a physical blow. A domino effect toppled dozens of other banks. Desperate crowds swarmed the financial district. To halt the freefall, the New York Stock Exchange took an unprecedented step. It closed its doors for 10 days. The market had not just crashed, it had ceased to exist. The panic of 1873 was no longer just a financial crisis. It was rapidly becoming an industrial depression. With credit frozen, the nation's economic engine seized up. Railroad construction, the primary driver of Gilded Age growth, ground to a halt. Factories shuttered their gates, their smokestacks going cold. This was not a short shock. It was the beginning of a prolonged economic misery. Long before the crash of 1929, contemporary observers gave this era its own grim title, the Great Depression, a period of unprecedented unemployment and violent labor strikes that would define a generation. At the core was a familiar enemy, over-leverage and an intoxicating faith in eternal growth. In an era of unprecedented optimism, caution was dismissed as cowardice, creating a bubble of historic proportions. For the first time, capital flowed freely across the globe, connected by telegraph and steamship. London, Paris and New York formed a single financial ecosystem. The first globalized credit system had dangerously overheated. The parallels to our own time are uncanny. Replace railways with tech stocks. The narrative is the same. A revolutionary technology promising to reshape the world. attracting vast sums of capital based on future profits, and replace gold with fiat currencies. The physical constraints of the gold standard were swapped for the political will of central bankers. The pattern is identical, a blueprint for crisis repeating across centuries. The anatomy of the cycle is always the same. Cheap money breeds confidence. Whether from war reparations or quantitative easing, a flood of liquidity lowers the cost of borrowing and risk is mispriced, then ignored. This unshakable confidence, in turn, breeds leverage. In the Gilded Age, investors toasted their genius as they signed for loans on margin, certain the market could only go up. It felt like a foolproof strategy, but leverage is a double-edged sword. When the tide turns, it amplifies losses just as it amplified gains. The entire fragile structure, built on borrowed money and wishful thinking, comes crashing down. Leverage breeds collapse. The final act is always triggered by a tightening of credit. In 1873, central banks tightened gold reserves. In the 2020s, they tightened liquidity. After a decade of zero rates, different centuries, same outcome. From the Gilded Age to the digital age, the language of finance has evolved, but its grammar remains unchanged. The story of 1873 is not just history. It is a blueprint woven into our economic system. It's a reminder that while technology and politics change, human nature, our capacity for greed, fear, and collective delusion, is a constant. The forgotten crash of 1873 isn't just history, it's a blueprint. When everything looks safe, liquidity is already drying. When every asset is leveraged, the spark only needs a name. In 1873, it was J. Cook. In 2008, Lehman Brothers. In 2023, maybe a sovereign fund or shadow bank. Smart money remembers what the crowd forgets. Debt is a promise, not a permanent state. History teaches a stark lesson, often obscured by complex economic forecasts. Empires don't fall when their treasuries run dry. They crumble when the foundational pillar of belief gives way. This belief is the invisible architecture of our financial world, the shared conviction that the paper in our hands holds value, that debts will be honored, and that the system itself is sound. It's a delicate consensus. But when it fractures, even the most imposing institutions can reveal themselves to be hollow, their strength merely a reflection of our collective faith. The Panic of 1873 was a brutal awakening. The world was riding a wave of expansion, fueled by credit and the promise of growth, all built on the assumption that gold could cover the mountain of debt. When a major bank failed, it triggered a global chain reaction. The world pulled back the curtain of credit, demanding to see the substance behind the shadow. What they found was a cavernous gap. The gold was never enough. The realization plunged economies into a long depression, proving that credit is and always has been an act of faith. Today, we operate in an even more abstract world. We've untethered our currencies from gold, placing our faith not in a physical commodity, but in the decrees of governments and central banks. As we print and borrow our way through the 21st century, we are conducting the largest test of collective belief in history. National debts spiral into the trillions, while digital money is created with a keystroke. We are stretching the fabric of credit thinner and thinner, prompting a familiar, haunting question. How many times can we forget the same fundamental lesson? The cycles of history are clear, yet each generation seems to believe it has found a way to defy financial gravity. To understand the future, we must decode the past. Subscribe to Finance Arcana, where financial secrets meet timeless lessons. If you found value in unraveling these hidden patterns of finance, don't let the story end here. Like, share, subscribe to Finance Arcana for more untold histories, market mysteries, the timeless secrets that shape our world. Every week, we peel back another layer so you can see the forces moving behind the curtain. Stay curious, stay informed, and together, let's decode tomorrow. Thank you for watching The Forgotten Crash of 1873. Stay tuned to our other upcoming episodes of the Lost Lessons of Money series.